Good morning, everybody. Welcome back to Morning Markets on Tuesday, the 12th of May. A couple of things that we've been discussing as an investment team today. The first of which is just the performance of equity markets overnight, where we saw a continuation of the trend from Europe. Yesterday we were at a relatively negative day, feeding into the US, although not to the same extent. And just as we touched on last week, we continue to see the ongoing divergence in the US market, with the Nasdaq continuing to contribute positively and sort of the S&P lagging. And one of the reasons that we've discussed there has just been the preponderance of the type of stocks within that index, and those are the type of stocks that the market does seem to be favouring at the moment. Turning then to Asia overnight, we continue to see that trend of a slightly weaker performance feeding through into Asia. I think the situation probably exacerbated ever so slightly by the ongoing news flow around COVID-19, particularly as it related to the first spike in cases in Wuhan since the epicenter of the global pandemic has emerged from its own lockdown. So that merits just a little bit of caution, and that's obviously been seen in markets. As we've discussed in a number of these videos of late, market sentiment will clearly be influenced by sort of ebb and flow based on news flow around COVID-19, and that's I think what we're seeing today. And that didn't really feed that much into other markets. Looking at sovereign bond markets and currency markets, maybe the dollar is slightly stronger, but that's to be expected in a slightly more adverse equity market environment. The other thing that we were just touching on today was the performance of some of the precious metals, in particular gold, which continues to hold above the $1,700 per ounce. And then just the silver price, which does appear to be playing a degree of catch-up. You'll have heard us talk before about the spread or the gold-silver ratio. That had moved out to extreme levels, and what we are seeing is a little bit of catch-up in that over the past couple of days. So that's something, again, that we will continue to monitor, and something that a number of our managers have alluded to over the past number of months. The other data points that we were looking at today were just some of the inflation data that came out of China. The inflation print itself was lower than expectations, coming in at 3.3% year on year. Probably the more interesting aspect was producer prices, so effectively the price of goods leaving the factory gate, and that they declined 3.1% year on year. That gives you an indication of the magnitude of the negative or the deflationary impulse that COVID-19 is sending through the Chinese economy, but also through broader economies. Again, that speaks to probably why we heard from the PBOC, People's Bank of China, over the weekend in their monetary policy report, talking just about their willingness to provide further support to the economy, and certainly looking at those inflation numbers, they do have the potential to do that. Finally, today we got the announcement overnight from the Federal Reserve in the US that they would be commencing their corporate debt buying program, I should say. So if you remember, this was something that was announced a number of weeks ago in the midst of the liquidity crunch that we were experiencing. What does this mean? Well, the Fed, through various operations, will be able to buy ETFs in the secondary market. Those ETFs will be both for investment grade and high yield. They've set a number of criteria around those, and they can be seen on the press release that came out last night. I think the key thing here is just to think about where spreads, i.e. the compensation that investors require for buying corporate paper over and above that of sovereign, i.e. treasury paper, moved out quite significantly. It's come in on anticipation, I suppose, of this program and improving liquidity environment. It'll be interesting to see how these markets behave over the coming days. Something that we'll continue to watch and report back on. On that point, please do look out for my colleague Chris Leyland today, who will be discussing our chart of the week, which just looks at the magnitude of issuance in the investment grade market and speaks to the fact that, yes, the Federal Reserve are effectively backstopping the investment grade and, to an extent, the high yield credit market. Many thanks for watching today, and I look forward to speaking to you again tomorrow. Thank you.